Okay, good morning, everybody. My name is Josh Lipson, account executive here at Alpine Brokerage. Thanks for joining us this morning for the latest edition of Alpine's ongoing webinar series. We're going to record this presentation, so we will not open it up to questions. If you have any questions, please write them down, and after the call, reach out to your account executive at Alpine, who will be happy to help you. Today's presentation is called Unlocking Your IUL Sales Potential, and our presenter is Steve Zimmerman, Vice President of Sales at North American. So without further ado, I'll turn it over to Steve.
Hey, Josh, thank you. Good morning, everybody. This is Steve Zimmerman, as Josh mentioned. I am one of the regionals or sales VPs with North American. I have the privilege to be able to work with Alpine and to be engaged with you guys today. So thank you for taking a little bit of time out of your morning. And, you know, our goal is to give you some very specific ideas to help you do some business, open and close some new client situations, because you're taking an hour out of your productivity time. So let's find a way to help you make some money. So what we're going to do in probably 30 to 40 minutes is we're going to take a high-level look at not just your IUL, even though that's our focus. We're going to talk about 2018, why this should be your best life insurance sales year ever. We're going to look at economic conditions. We're going to talk a few minutes about client concerns, and then really importantly, living benefits, because today the living benefit side of life insurance is really more important than ever. I'm going to walk you through a little bit of demographics and information on IUL, which pertains to that, but also the bigger picture. I'm going to then show you a very specific case study, and we're going to wrap up with a couple of ideas on how to simplify your sales process. So what I would recommend is we're going to move pretty quickly, keep some notes on areas that interest you, and I would suggest you get in touch with your Alpine account executive. I mean, you see my contact information on there. There's my office, my email. Think of me as an extension of the Alpine team. Call me if you'd like. In addition to that, call your Alpine account executive, and their number, as you know, is 866-777-2006. So why don't we get going? Let's take a look at IUL. But before we do, let's talk about the economy. Look at what's going on right now. The markets are at all-time highs. But we do see interest rates starting to tick up a little bit. So what's going on? We're looking at probably higher probability of a recession or greater market volatility and correction. But you know what? We really don't want to get out of the market. So how do you do this and win? We want a strategy where we can still participate in the up days on the market, but never lose money on the down days. Sounds like index products to me, doesn't it? So we're sitting here with client needs. I do a lot of work with clients just like you do, and whenever I talk to clients or I speak to client seminars, I always love to ask, what's on your mind? Is there anything that keeps you awake at night? And I invariably get these answers, and it's in this order. The first thing I always get is, I'm worried about my money. I'm worried about a market correction. You know what? I came back from the '08 market correction, but you know what? I don't want to do it again. I'm worried I have enough for long-term longevity and retirement. I'm worried about long-term care. And you know what? You know, I'd kind of like to do something for my kids. I really love them, and I really love my grandkids, but I'm not sure I want to give up all my money and give it to them yet. And isn't it normally in that order? So what we have today is, with life insurance and the living benefit side, we can more than ever before satisfy helping your clients with their living needs of those things we just mentioned, and still have flexibility with their dollars in the policy. And if they don't need those for their own living benefit needs, we can pass it tax-free to the kids. So that's where we're going right now. So let's take a look at IUL. IUL is becoming the workhorse product in the industry, and let's take a look at it. So unlocking your sales potential, IUL. We're going to look a little bit today at the average purchaser, their mindset, demographics, and we're going to talk for a minute about some of the living benefit features that are most attractive to clients today, and we're going to wrap up with a very specific case study. So, average IUL purchaser today. Here you see average age 42, average target premium just a little north of $9,000, average face amount about $500,000. But what I would submit to you is, now that we're seeing carriers put guarantees, like a no-lapse guarantee or a GUL on an IUL chassis, we're seeing IUL products used for pretty much the entire client spectrum. So a little bit on where we're seeing the sale. 80% of IUL sales is cash accumulation, but you see there almost 12% for death benefit. That's growing rapidly with the prominence of guaranteed IUL. For only a few dollars more per year, maybe 1, 2, 3% more with a guaranteed IUL, you get all the benefits of a GUL and cash and flexibility. So the next time you call your Alpine account executive with a death benefit need, I would encourage you, get a GUL and get a GIUL. Go into that client meeting with both in your pocket. Crediting methods, annual point-to-point, probably what we see most. There's other things you can use, but this is already a complex process with a client, so I would recommend keep it simple. S&P 500, annual point-to-point is what we see being used most of the time. What I'd also suggest is if you want to dig into a little bit more detail, you see our second option there, multi-index. There are multi-indexes, which means you have global exposure, Eurostock, S&P 500, things like that. And with the U.S. markets as high as they are, just keep in mind, in the last 25 years, the U.S. markets have only been the #1 market versus the other markets around the world about 25% of the time. So with the market high right now, with market correction potential domestically, might make some sense to look at a global index as well. But you know what? Talk to your Alpine account executive there. The size of the market's huge. In 1998, it was barely $60 million. In 2017, we're approaching a $2 billion market with IUL, and that's just, it's a multitude of factors where we as an industry and the carriers are evolving to using that as the workhorse product. So what does the average purchaser look like? I'm not going to spend a lot of time here, but think about this. This is kind of almost looking in the rearview mirror. Average purchaser, 35 to 55, higher income. But what I would suggest to you is, now that we have very strong guaranteed IULs that you would use interchangeably with a GUL, these ages are going to be a lot higher. But those last 3 bullet points there, client likes flexibility and cash value. So think about this as living benefits as much as death benefit. They value access to the funds in case of an emergency. And that last bullet there, they really understand this is life insurance, not just death insurance. So we have those needs the clients have. I want to make sure my money's safe. I want to make sure I'm protected in the downside event in the market. I'm really concerned about long-term care, and I'm not so sure I want to spend 5 to 10 grand a year on traditional long-term care insurance. We've got living benefits that are a big part of the sale and the interest in the clients. Okay. Mindset of the average IUL purchaser. Now, I love this stuff, and I know many of you have seen things over time, looking at the generations, looking at demographics. Now, think about this. We've got baby boomers, Gen X's, and millennials. Are there any differences between baby boomers and millennials on how they act, how they communicate, how they buy things, how they do things? I mean, you're darn right there are. Think about it. So the question I have is, are their financial needs different? And in reality, many of their needs are very similar. Question: are millennials and Gen X's typically more conservative or aggressive with their money? I get a lot of times people saying they're more aggressive, but in reality, they're more conservative. Now, why is that? Look at the years from 2000 to 2010. This was the birth of risk aversion. This is the period after that market correction. So you see there from 2000 to 2003, the market cut in half. By 2008, it basically grew back to where it was pre-correction in 08. Then after that, 2008 to 2009, it dropped 57% again and then started creeping back up. This is where younger clients have really gotten their foundation of being very risk averse. So here's a great example where if we had these market movements, and let's just assume we had caps and floors like in an IUL product. So you see, in that period from 2000 to 2003, we wouldn't have lost 49% in an IUL product. We would have stayed equal or had been zero. Then from 2003 to 2007, we would have captured the growth. 2008 to 2009, we would have remained constant and not lost the 57%. and we would have participated in that 2009 to 2010 growth. So let me give you context here. Had you started with $100,000 in this scenario on the screen, you would have ended 10 years later with $78,000. Had you gone through the same 10-year period with an IUL with caps and floors, you would have ended that same 10-year period with $170,000. So 78 versus 170. We have an extremely compelling story, and this is what clients need to see as far as education goes, and these are some of the features, especially right now, that clients like. So here's some of the the client concerns we've talked about, losing money in the stock market. Here's an interesting one, life insurance coverage gap. I'm going to show you something in a minute, but the percent of Americans that own life insurance is down. It's dramatic. People don't have enough coverage. There's a retirement gap. I mean, I think we all know that. Chronic illness or long-term care. And my grandmother made it to 99 a year ago, and she went through all her money. If you just ask people, hey, have you dealt with long-term care, either relatives or friends? People are concerned about this stuff. And then the last thing, lack of awareness. I think we have an incredibly important role to educate our clients and prospects. And the most effective advisors that I see are the ones that are providing education and training. Okay, well, let's take a look for just a minute. I think some of these next couple of slides may not be information that'll totally surprise you, but I think it's really helpful for context. Look at this, the top line there, the darker purple line, that's the percent of Americans that own life insurance. So you see in the last 40 to 50 years, it's down dramatically. But the part that jumped off the page to me is if you look at those bottom two lines, the pink one and the green one. The pink line is group insurance, and it's striking that in the last 20 years, there's a higher percentage of Americans that are satisfying their life insurance need with group insurance than individual policies. So I would, take a note, if you want to call your Alpine AE or call me, we're going into the fall where many of your clients are going to go through their annual enrollment. It's benefits, it's medical, dental, health spending accounts, this kind of stuff. I would ask clients, are you buying extra life insurance in your benefit plan? If you are, we should talk about this because group insurance in the life plan, it's easy, it's convenient, but it's not portable and it probably costs more because it's a blended rate than something a healthy person could get on their own. So take that as an aside there. So coverage is down, people buying insurance is down. Average life insurance gap is about 200,000. And we see average group insurance covers two to three times salary. So there's a high probability that there's still a coverage gap after people having group insurance. Now, this one was particularly interesting to me as well. This is looking at time to impact. If we lost the primary breadwinner in a family, how long would it take until the surviving family members felt a significant financial impact? You see there 1 week it's 15%, 1 month it's 23%. But the box that I highlighted there is within 1 year, 65% of Americans would feel a significant financial impact. And this is based on a LIMRA study from 2017. Now, take a look at this. The one that's probably most concerning to us is 19% on that far right there have no clue if there's a problem or when there would be an impact. So again, this is something where we have to come in as the financial advisors. A couple questions I would ask. Mr. Client, do you have life insurance? And a big question to ask. This is a fun one for us. Do you have the old kind or do you have the new kind? The old kind of life insurance or the new kind? And they're probably going to look at you and they're going to say, what the heck are you talking about? Then that's the thing. Do you have the old kind without living benefits? Do you have the new kind with living benefits? So we want to help you with helping your clients with a policy review. Chances are we can provide you something either better or uncover a sales opportunity. Also, how did you come up with that amount of insurance you have? Did anybody ever calculate the amount of insurance for you? So the Alpine guys and I, we can help you there. All right, quick other things on the retirement gap. More numbers I don't think is going to surprise anybody on this call, but if you just look at this, this is as of August of last year. Average 401k balances in the U.S. is $73,000. And more importantly, Average 401k balance for people in their 40s and 50s is a little over 100,000 at 116. So the question I love to ask is, Mr. Client, Mr. Prospect, how do you feel right now in terms of your retirement preparedness? Are you on track? Have you saved enough money? And see what they say. And I bet you most people are going to say, I'm uncomfortable. I don't know. Can you help me? So I think we have a huge opportunity there. So these numbers might be helpful. Okay. Long-term care. We know a lot of the statistics. We know the probabilities of people needing the care. We know the average length of care. It's high. So you see here the staggering cost of long-term care, private room, licensed health aid. You see out-of-pocket for cancer and treatments like that. This is huge. Now, the other thing that's striking to me is only 7% of consumers own long-term care insurance. So another topic to take away as a follow-up item is I like to describe it as there's 3 legs on the stool for long-term care coverage. There's traditional long-term care insurance. There's linked benefit products like a Lincoln MoneyGuard, for example. And we're seeing the third leg is life insurance policies with accelerated death benefit liquidity. Many, and the majority of LTC solutions are being solved or problems are being solved with life insurance solutions. So the question here, Mr. Client, Mrs. Prospect, how do you feel about your preparedness for long-term care? Have you had any occurrences in your family? Do you know anybody that's dealt with this? And the benefit of using a life policy is it's almost like having an option on long-term care that you don't have to pay an extra rate for on the front end. If you have a life policy with an LTC or an accelerated rider, if you need the benefits while you're living, and the benefit triggers are usually the 2 or 6 ADLs and cognitive impairment, if you need that, you can accelerate the death benefit. At the time of claim, if you use it, there's a discounting at the time of claim. That's where the payment and the company recoups the cost. But the benefit is if you never need long-term care, you don't use it, and you keep every dime in your policy. Okay. It's a basic fundamental consumer assessment here. We see 84% of consumers believe having access to funds is important. But did you know only 48% of consumers know they can borrow against their life policies? So we see here huge opportunity, huge education issue. So what I'd like to do now is let's tee up and take a look at how a life policy, and it's usually an IUL just because of the efficiency of how the product works and some of the features we've talked about. What are we looking at as an IUL? And I go back to my Boy Scout days and I think about a Swiss Army knife as a metaphor. The life policy today is going to be doing multiple things, giving us control of our assets, control of the money, but not being locked into going down any one path. So death benefit protection is the first. Obviously, it's life insurance. Then growth. We're in a place where we want our money to go. We'd like to have an inflation hedge. We'd like to have some downside protection because I want to sleep at night. And then also the tax efficiency of life insurance. Beyond the scope of what we have time for today, but if any of you would love to talk about the future of taxes going up, if you think about Social Security, you think about the national debt, it's probably pretty unlikely that we're going to have dramatically less taxes or lower taxes in the days ahead. So getting your higher income and net worth clients into a tax-free bucket is probably what they need. Supplemental retirement income, the lower left there. Life insurance is one of the few places you can pull money out totally tax-free, and then access to a portion of this while you're living, and that's the chronic. That's the long-term care types of services. So let's take a look at a hypothetical case study. What I'm going to do here is I'm going to switch over and I'm going to just make this a little bigger. Now, I would encourage you, I want to use this as a tool to walk you through. What I would also suggest is this illustration and this document that we have on the screen right now is something we'll be happy to send you. So I want to use this to guide us through the next few minutes. If you like this or you'd like more detail, contact your Alpine account executive, contact me. We'll be happy to send you this. And if you have any other specific questions, we'll be happy to send this to you or anything else too. So let's now take a look at a specific case study. I'm going to say to you, there's probably 3 basic client profiles we're dealing with a lot right now. First thing, it's going to be, this one is retirement planning. So it's a pre-retirement client. I'd say maybe 30 to 55, a professional, a small business owner. Frankly, it's going to be someone that's making a good amount of money, that has a little extra that wants to save. They want to save more for their future. But you know what? They got a lot of things they want to do. I'm concerned about my family. I'm concerned about premature death. I'd like to save. And it all goes back to that savings, downside protection, taxes, and I want these dollars to do double, triple, and quadruple duty for me. So first profile, and we're going to look at it here, is going to be your pre-retirement client. Now, the second couple of profiles that we're going to see, we're not going to go into it today, but if you want to dig into this, call us later. The retired client, 60 plus. I'm seeing 2 specific cases where the Alpine guys and I are doing a lot of work. Number one is that client that has a lump sum asset. Maybe it's a client that's got a $50,000 CD at Wells Fargo or Bank of America. And they're probably going to say, you know what, I just renewed this CD at 40 basis points, and I'm pretty upset or pretty disappointed how low that is. But you know what? I don't know what the heck to do with this money. I don't want to lose it. The market's kind of frothy, and so I'm leaving it there. So what we can do with those clients is we can evaluate and potentially reposition that liquid asset, that never money. And you know, another way to look at it is it's my live-on assets versus my leave-on assets. We can help clients with take that lump sum, move it into a life product where immediately on day one, they have a better projected living value, higher amounts and the whole downside protection, tax control, higher amounts for the kids, a greater amount available for long-term care. And in some cases, we can actually structure the policy where there's 0 surrender charges, so they have immediate access from day one. The other situation we would do, and now I'm kind of talking about some of the life insurance 101 that you guys do every day, is that retired client that might have cash flow. It might be required minimum distributions or RMDs. It might be unneeded portfolio income. It might be a pension that they don't need all the income. And that's usually the client that typically says, hey, you know what, let's buy a little life policy or a big life policy. I want to do something for my kids and family. Now, with the estate tax exemption as high as it is, we're seeing people these days, they don't have to get the policy out of their name. So that second scenario with the retired client is going to be, let's buy a policy with guaranteed death benefit. We'd like to do something for the kids. But then the sweet spot for IUL is we give you all the benefits of a GUL, but we give you all the living benefits of an IUL pushed and married together with all the flexibility you want. So be thinking about those retired clients. Let's talk about that later. So now, let's go back to the retirement planning case study. Here's where I'm going to walk you through a quick example of the product, how to simplify the illustration and maybe your presentation, and then some tools we have available through Alpine Brokerage. So here's the profile. We already talked about it. You know, pre-retirement, want to accumulate assets, family's important, needs life insurance. They're saying, Mr. Advisor, can you just help me with the best way to save for the future? And I'm confused after looking on the internet. There's too many things. There's too many opinions. So let's take a look at this. So now what we'll do is I'm going to use the Builder Plus product really just to illustrate the point. You're going to get very little product pitching from me here. I don't think that's the best use of our time. Just know the Builder Plus product is an extremely competitive product in the marketplace. If you like the ideas we're talking about today, go to the guys at Alpine. They can bring you any product in the market, and I'm comfortable that ours will stand tall in the competition. But our goal today is to give you ideas on how to sell, not pitch you on North American. So what I'm doing here is I'm using an example of a male 45. I'm running this at preferred, one off the best class, and I'm saying maybe it's a business owner or a doctor, lawyer, and they're saying, I've got some additional money per year. I have $24,000 I want to put away and save for retirement. So what I just did was I said, 24,000, I circled it on the illustration, 24,000 a year in annual premium for 20 years. I solved for a minimum death benefit you see of 568 up here. Now there's something we have called a return of premium death benefit option. and I'll make one comment, and if you're intrigued, we'll give you more information offline after the call. You know that the best way to maximize performance on a life policy when you're doing a minimum phase for accumulation is to run an increasing death benefit during your funding years and switch it to a level death benefit in your post-funding income years. What's the problem with that? I'm going to tell you, Mr. Klein, mark your calendar for 20 years from now, call North American or the insurance company and say, hey, 20 years from now, switch my death benefit from increasing to level. What's the probability your client's going to remember that? I don't really think a lot. So return of death benefit option is something we have just produced. It's very unique, and basically you get the best of both worlds. You get a lower increasing death benefit, and you get a policy that doesn't need to switch. So just know, if you're intrigued with that, next time you have an accumulation case, we'll show you both options. So male 45, we're going to pay $24,000 a year, and we're going to pay that to 65. Now, what I want to do here is I want to simplify and show you how, if I was sitting with the client, I would present this to them. So let me ask you a question, a rhetorical question. One of the things I get when I talk about life insurance is, has anybody ever said to you, hey, I don't know about that life insurance stuff because that's a crappy investment. It's too expensive. There's too much commissions. You know what? It's a bad place to grow money. I'm kind of a term and invest the difference guy. That's what I see on the internet. So what I want to do here is I want to debunk those myths. So funding through 20 years. You see here, we've paid $24,000 for 20 years. We have a total premium of $480,000. At year 20, we have a cash surrender value of $982, and we still have just under $1.2 million a death benefit. But let's look where this thing really shines is let's look at the distributions. I am using variable participating loans. If you want to dig into that after, call the guys at Alpine or call me. I'll walk you through it. We were able to pull out $109,000 of variable participating loan distribution cash flow. A variable loan very simply just means that there's a charge and a credit for those dollars, as you know. With a variable loan, you're going to be charged a fluctuating amount equal to a market prevailing rate. Many companies, and this is where it's exposed and why some advisors don't like this, a lot of companies don't put real significant caps or protections on there for the loan interest. What we do is we limit the loan charge to 6%, so it'll be within a 3.5% to 6% rate. I run my illustrations, all of them here, especially with a 6% rate. So I'm charging you the highest amount the contract will allow. And then what we do with a variable participating loan is those dollars that are being taken out, instead of earning that 1.5% in the general account credit, they're going to earn the prevailing interest credit. So you've got an arbitrage opportunity where if your index credit is higher than the loan charge, so if your index credit is higher than the 6 I put in here for the loan charge, you're going to have a positive arbitrage contribution. In an illustration, we can only run, and this captures a 1% positive contribution. In reality, what your client could experience is it probably could be a lot more. So you see $109,000 coming out. I ran that for 20 years. So at age 85, and this, what I'm putting these circles on is to help you with how I'd present this. So at age 85, you see we still have a max contribution of $480. We've taken out 2.1 or almost close to $2.2 million of tax-free distributions. We have $530,000 of death benefit left, and you see a little over $300 of surrender value. So I want to say here, if you look at 85, life expectancy is probably 83 to 85. If you were to make it to 85 and then pass away, you would have had the policy produce a $2.7 million economic benefit based on a 480 contribution. So another way to look at this, and I get into these conversations with financial advisors, or, you know what if you're talking to a client and the client says, you know what, my Merrill Lynch advisor says life insurance is a crappy investment. He can do much better managing the money in an AUM account at Merrill or wherever. So I love to use the internal rate of return report. If you don't use these, start using these with the quotes you get. Talk to your guys, your account executives at Alpine, and then let us help you there. So the internal rate of return is the rate you would get on the cash flow of the policy. So premium payments in, distributions out. So what I wanted to point out here, you see that this is the internal rate of return on the surrender value after my premium paying period. So we've paid $24,000 a year. Here's our surrender value. And I'm showing you the IRR in year 20 is 6.41%. Now, how do we compare that? Compared to what? I'm running the illustration at 7.06. 706 is our illustration cap, is mandated by the regulation AG 49. I can show you that the historical returns in these indexes is 1 to 2% higher than that, so I can validate that, or we can run these quotes at a lower rate. But basically, if I'm running the illustration at a 706 crediting, why is my IRR not 706? So obviously, you know, it's because of the policy charges, the COIs, and so on. But if we look at this, after 20 years, 706 is our credit, 641 is our effective internal rate of return. So the difference between those two must be our costs in the policy. So 706 minus 641 is 65 basis points. So let me ask you a question. If that Morgan Stanley advisor is poking holes in your life quote, if they were going to have a managed money account, an AUM-focused managed money account, what would that advisor be charging your client for AUM annual fees? Maybe 1%, maybe 1.25%. I mean, if some of you on the phone or do AUM work, you know that. What do you charge for managed money? 1%, 1.25%, maybe even a little bit more. So if I can give you all these benefits in the products with a 65 basis point charge or drag, I'd say that's pretty damn competitive to an AUM versus investing. So let's keep this thing moving. What I want to show you now is we have a tool. Just be aware of this tool. I'm not going to spend a lot of time here. This is a program called INSMARK. Just know that Alpine has a modeling tool available where we can use the life insurance data, which is over here, and we can plug in the same cash flows into hypothetical assumptions. So what I did here was I just said, let's put the $24,000 a year into an investment account, and I just entered the assumption, 7% return, 25% tax bracket, and we see in the early years the investment side looks pretty good. But when you start taking money out of the policy, oops, sorry about that. Sorry. All right. When you start taking money out of the policy, to net the same after-tax distributions from the investments, you have to take more money to pay taxes. So just know here, we can do modeling for you. We can be as complicated as you want if you have engineer clients, or we can show you very simple illustrations. But we can quantify the strength and the efficiency of life insurance versus other investments. The goal is not to discredit other places, because obviously we have lots of needs for other types of places to invest and save money, but it is just to represent and show that those stereotypes of life insurance being a poor place to put money due to costs and expenses really is unfounded. So if any of you would like this or some of the other examples we talked about, the retirement case studies, we can give them to you. What I'd like to do now is I'm going to pivot. We're kind of in the home stretch here. It's 10:33. We're probably going to try to wrap up in about 5-8 minutes. I want to give you a little bit of extra time back. Excuse me. Okay, so what I want to do here, quick comment on an exciting change of term insurance. So I said I wasn't going to talk much product. I really don't want to, but I'm so excited about this. I got to give you one quick comment. Then we're going to wrap up with a little bit on simplifying your underwriting process, and then we're going to get out of here, and we'll follow up with you after the call. So as of yesterday, September 24th, we have introduced living benefits on term insurance. So you're familiar with on permanent insurance, living benefits is chronic, critical, and terminal. With term insurance, now we've added this as well. So in addition to the terminal illness that you're used to, we've added critical and chronic on term. We're not going to increase the rates, So the policies you buy or the policies you've looked at now will be issued with this additional endorsement on the policy. What we do is at the time of claim, we will do an individual assessment based on life expectancy and severity of the claim. There will be a discounting or a haircut on what's accelerated and paid through. So you've got a benefit for the clients. So what I would suggest here is living benefits on term. Living benefits on permanent products may have more of a focus on chronic or LTC. Living benefits on term really might be more appropriate if you're looking at the critical illness. And think about this, that 1 in 4 people under the age of 65 will have a critical illness: heart attack, cancer, stroke, kidney failure, organ transplant. And what we will do here is, for critical illness, we will accelerate up to 90% of the policy death benefit up to $1 million. So you have a significant living benefit that you can also talk to your clients about. Do you have the old kind of term insurance? Do you have the new kind of term insurance? So I'd say take a look at this. Quick comment here is, if you do shop term, as many of us do, take a look here and you see some of the prominent life carriers that have a term with living benefits. I think you'll find that our product stacks up very well. Also, if you think about the term, the conversion is convertible to the entire product portfolio, and you can convert in the first 5 years of the policy without any kind of evidence. I'll just switch a little bit now and say, how can we make your life easier submitting business? Now, many of you that have been around for a while, you may not mind the underwriting process, but some of you that may want to do more life insurance, but maybe you do focus on planning, maybe you do focus on investments. You know what? A long life insurance application, a 30 to 40 page form that you have to fill out with a whole bunch of size 3 font disclosures. And what about a process that takes weeks? You know what? If I could only shorten that and make it a little easier, I would just do more of this life insurance stuff. So we aren't the only company that has these tools, but we're one of the really good ones. So what I would encourage you to do is talk to your Alpine AE and then explore some of these ways we can make your life easier submitting business. So the first thing I have here, simple submit. Okay, in English, what I'm saying is this is an e-app. This is a paperless application. If you go onto your iPad, you go onto your computer, this will provide all the inputs for you to answer questions and submit your case. 2 benefits to you. Number 1, it's going to get in faster. Number 2, it will not allow you to miss a question or leave something out. So we're eliminating the probability that you're going to get that dreaded phone call in a week that says you missed question 7 on page 6. You got to drive back out and see your client. Now, if you use the e-app, you see our second option there is called Right Away. This is accelerated or non-fluid underwriting. We're going to use LexisNexis for clients up to age 50, up to $1 million of death benefit for both term and perm, to do a LexisNexis search. And if your score comes back with data that's sufficient, we're going to skip your exam, we're going to skip your fluids, and your case will be issued in days, not weeks. We're seeing currently between 40 and 50% of our submissions coming through skipping the whole exam and fluid process. If your client doesn't get to skip those parts of the underwriting, there's no penalty. They just go back and they go through full underwriting, and then that would go to the Alpine back office as you're used to. And then the last thing we have here is the drop ticket. And this truly is easier. It's through the applicant platform. And this is where you would go in, you do brief inputs, you put in something similar to maybe an illustration, client name, state, product, amount of death benefit, you hit send. And then we take it from there. We would call the client. We ask the questions. We set up the exam. We do it all for you. So we've got some ways to make your life easier. So with that, guys, I think I would like to just maybe wrap up the call and just summarize. right now in 2018, going into 2019, with our economic climate the way it is, there's never been a better time to sell life insurance. Your clients need your help. They need help with the market. They need help with market volatility. Long-term care is a huge concern and the financial landscape's evolving. Clients want to do things for their kids and grandkids, but they don't want to give up control of the assets. So life insurance solutions right now, because we can still keep them in our estate, gives us flexibility and control of the assets to use them when we're living or pass them through if not. IUL is becoming the product of choice. We're seeing for a multitude of living benefits as well as death benefit reasons, and there's really no reason not to include that IUL in your death benefit case design. With the case studies we saw, we can get very specific and help you with where these products are being sold. And also, the next time you have a client case you're looking to do some work on, come to us. Let us help you with the case design. Let us give you ideas of what we see other people doing effectively. We may not be able to tell you something you don't know, but you know what? Maybe we can share something that somebody else is doing that's working well, and we'd love to help you there. And then also, I guess, lastly, keep in mind the things that the Alpine AEs and my team and I can do to help you with simplifying your process to improve your paid case ratios, get things done even faster. So with that, Josh, I'd love to just thank everybody for joining us. Call your Alpine AE, give us a call, and thanks for the time, and we look forward to serving you in the days ahead.
Thank you, Steve. There was a ton of good information in there, and I hope everybody wrote notes on things that were of interest to them. You know, it's funny that you mentioned old kind, new kind. I have seen more life insurance commission be made by simply asking that question over any other question I have ever seen. And now with the advent of the living benefits on the term, you know, it just adds to the reason we should be talking to clients about the new kind, right? The old kind, you got to die to use. The new kind, you can use a number of different ways while you're living. Another thing that I found that kind of plays on that was an interesting statistic you put up on the board earlier, which said that 7% of people own long-term care insurance, you know. And then another statistic I saw up there was a couple age 65 has a 93% chance that one is going to need long-term care. So there is a huge gap there. And positioning some of these products as a Swiss Army knife that provide death benefit, provides cash accumulation, provides living benefits, is a great way to solve those problems. Another thing you mentioned was the INSMARC report. That is something that North American has made available to us in assisting our clients, you know, the advisors out in the field. And it's really the only tool that I use when I sell, you know, to my clients. I would say that the first time a client actually looks at the illustration is when I ask them to sign it. So I talk a lot about the concept and how it works and how it benefits them, and then I show them the INSMARC report. Everybody's got their own style. I know some focus a little bit more on the illustration, but I find that the INSMARC report is a very concise and easy to understand report. As far as the IUL, I know you didn't want to pitch product, but everybody who's out there who knows me, who has spoken to Chris and the rest of our team knows that North American is our, what we would call the flagship in that space. The product is phenomenal. The bonuses are guaranteed, unlike some of the other products that you might come across. But that's a conversation we can take offline. But yes, Steve was correct in his statement that, you know, while he doesn't want to talk product, he's comfortable putting his up against anybody out there. So I wanted to thank all of those who join us. If you have any questions, please reach out to your account executive at Alpine. Again, that number is 877-666-2007. Okay? Everybody have a great day, and we will talk to you soon.